All right. Good morning, good afternoon, and welcome back. So this video will be on premium, discount, and equilibrium. So we'll get right straight into it. So the algorithm sees the marketplace in three distinct phases of value. These phases of value help smart money traders determine the quality of that asset class in that time in price. So quality in the sense of price, how cheap or how expensive price currently is in that body of price action, right? So, and it does this from the higher time frame, distinguishing values from the higher time frame down to the lower time frame to get a precise understanding of the value of that current asset class. So, for example, if I'm selling a crate of egg for $4,000, let's put it that way. Let's say I'm selling a crate of egg for $4,000. What determines that $4,000 is an expensive price or a cheap price or its fair value, which is equilibrium? It's a fair based value price. How can you distinguish that? It is almost impossible to do that if the base value the base value or the previous values of that crate of egg have not been identified previously. So does that make sense? So to understand this, we use you must first understand the swing points of price, the swing points in price where we have impulsive swings and a turnaround in price. Those impulsive swings are notable price points to determine an expensive price and a cheap price, or let's say for a higher price or for a lower price. So we're using every swing point to make this illustration before we go into actual precision concept of this premium and equilibrium and discount. So for example, using this swing point, this swing low, this major swing low. So if you take your Fibonacci from this swing low to this swing high, let's switch this to equilibrium. So if you take your fib from this swing low to this swing high, so in this video we'll be interchanging the teaching on equilibrium, premium, and discount in one. So when I'm speaking on premium, you can still reverse that logic to understand discount. And when we are talking about discount, you can still reverse that logic to understand premium, while equilibrium is fair value in price. So when you have this swing point like this, these are the notable swings where you had an impulsive move in price. So when you see a rally in price action, that is the price injecting liquidity, because you have buy stops orders resting above here. So the market would want to get a counterparty for lower prices. In this instance, the market want to get the counter prices for lower prices, but before it does that, it will have to bring in impulsive buyers. It will have to bring in buyers in the marketplace to come and participate to offer them higher prices. So when price does this and offer those buyers, those uninformed money, when it rallies higher and offer them higher prices, they will buy here when price is expensive, when price is at a premium. So above a previous swing high is a premium, and below a previous swing low is a discount. This is spoken contextually. So it is not every previous swing high or every previous swing low that is a premium or a discount respectively. So you have to understand it contextually. So back to it. So when price rallies up higher like this, it's going into a premium in price and giving uninformed money higher prices for this asset class. So smart money, the algorithm will now use this liquidity, this buy stops liquidity resting above this high here, and facilitate sell orders which were resting below, which was resting above here, because these buy stop orders now will be triggered and neutralized. And to have a balanced price action, price must offer both buy side and sell side delivery in price. So because this buy side now has been swept, price will now seek sell side delivery in price. So, and sell side delivery will be resting at a discount. So the algorithm will seek sell side at a discount in price. So from a premium, price will seek a discounted price. So it does that here. And the discount is below the equilibrium. So price trades down below the equilibrium to offer a discounted price. When price is now at a discounted price, it means it is cheap. It's cheap for it is cheap to buy. So at the discounted price, smart money orders will be resting at a discounted price, either at an imbalance or at a at an order block, which for this instance is a down close candle, which is a bullish order block. So smart money orders will be resting there. So, and you want to use major swing points to understand this concept. So let's use being the current price action now. So when price made this relative equal highs here, uninformed money, non-professional traders that do not trade with time backing them, they will see this now as a resistant level. They will call this a strong resistance because you have a double top here. So when you have this, we call this a double top. So when you have this double top here, you have buy stop orders vesting here. So the traders that have entered a position to sell, to look for lower prices, they'll place their stop losses, which will be buy stop orders resting above here. So when it is time during New York session, from the New York session starts by 8:30 open. The New York session starts by 8:30 open, and when it does that, it rallies higher to purge out those buy stops orders which are resting there, and now it is now in a premium price. So when it is now in a premium price, it will drop lower. So when you have that drop lower in price and you are bearish from the higher time frame after you have a draw on liquidity, because to understand the premium and discount concept, you must first have a draw on liquidity. Not necessarily though, but to be precise in your dealings and in your understanding in price action, you must have a draw on liquidity most of the time. So now, when price has purged this, has neutralized these buy stop orders which are resting above here, and you find the swing highs and the swing lows, which is this and this. So your first target when you are coming from a premium is equilibrium. So you are selling from a premium price, from an expensive price, to unload or to offload your orders at a discounted price. So when it does this, you again, when you are bearish, you are looking for sales at a premium price to sell into a discounted price. And when you are bullish, you are looking for lower prices from a discount price to buy into a premium price. So let's continue. So when this buy stop orders has been neutralized now and price dropped lower below this low, you wait for a short-term reversal. So when you have that short-term reversal now, a clear range has been established now, this high to this low. So when you have that clear range established, you are looking for price to trade to a premium, PDRA. So because you are bearish and you're looking for lower prices, so when price does trade to a premium PDRA, you look for sales inside of those premium PDRA, which is above the equilibrium. So every PDRA from this fair value gap here, from this fair value gap and this last up close candle, which is this bearish order block you have here, these are premium PDRAs. So you are noting all of these premium PDRAs to look for sell orders at a premium PDRA when you have established the range, when a range has been established. So you are looking for price to trade into the premium PDRA inside of the lower time frame to drop down to a discount PDRA on the higher time frame. Does that make sense? So when we add this range in price action established here, price rallies higher to a premium PDRA and then is now seeking a discounted price. So this is the inner working and this simple description of a premium and a discount PDRAs. And another thing, every price point, every reference point in price that is above the market orders is a premium price point, and every reference point, every PDRAs below the market price is a discounted point in price. So for example, say you are interested in lower prices now, this sell side is a discounted reference point, this liquidity void here is a discounted reference point, this from this close to this low of this wick of this candle here, the midpoint of it is a discounted price. So this consequent encroachment of this wicks are imbalances. So when the algorithm sees wicks as imbalances, so price will seek the midpoint of that imbalance first before it comes to this. If it wants to come to this low, it will first seek this midpoint of this wick, which is an imbalance. So those any reference point that is below the current market price, because this is the current market price, below those current market price is a discounted market price, and above it is premium. So everything above that market price in that current dealing range is everything above that current market price is a premium price, and everything below it is a discounted price. So when dealing with premium, equilibrium, and discount, you want to have a clear, definable range of price action to understand where price is likely to draw to next and understand where it is coming from. Either it is coming from being an expensive asset to now be a cheaper asset, or it's coming from being a cheaper asset to then become a expensive asset. So that is the value matrix the algorithm sees price in, moving from a discount to a premium. So that is it. It is short and simple. So I hope you got something from this video. I'll talk to you next time, and goodbye.